Okay. Mr. Baggeson, you're up.
Okay, good morning. Eric Baggeson, Calpers staff. To follow on from the information that Ted and Elizabeth have provided to you, we just want to touch briefly upon, a couple of the slides that were attached to the risk segment of this report. The first slide I'd call your attention to is slide 11 of the attachment, and it's attachment 2 of agenda item 8A. What you have here are two pie charts. The pie chart on the left of the chart represents the actual asset allocation proportions. So these are the weights of the portfolio where that capital is invested. The pie chart on the right reflects the risk contributions of those allocations. And what you'll see in this is that we have a little bit over 55% of the portfolio capital allocated to what we call the growth-related investments, which are public equities and private equity. What you also see, though, is that the risk contribution represents almost 85% from those two segments of the portfolio. So the risk contribution is almost 30% higher than the actual weight contribution. You see the effect of that in the line chart on the bottom of the page, where basically the outcome to this plan, its investment results, traces very, very closely to the results that are generated by these growth-related assets. So from this perspective, we just want to reemphasize the fact that this portfolio, despite having thousands of individual positions and all different types of asset classes, is still very much a growth-oriented, equity-centric portfolio. So the outcome to the public equity markets and the growth-related investments in large measure continue to determine the outcome to this plan. And I would remind the board that one of the actions that you have taken in the past, the whole risk mitigation policy, is really structured to try to eventually move towards the lower rate of return expectation that allows us to further diversify this portfolio and attempt to reduce that concentration of risk emanating from that growth-related concentration. When you look at that growth-related element, this is a Tulip chart that we've shown you before, which just tries to illustrate the variability in outcome, and this is cast in terms of the net asset value of the fund. So this is just the aggregate market value. But you literally see that the volatility in this portfolio, based on the capital market assumptions, I'll remind you that we had a 7% return expectation and an 11.4% volatility expectation. When you extrapolate that through just statistically, you see that there's a quite wide range of potential outcomes relating to the valuation of the fund. So there can be many different paths that this fund can experience, basically, in getting from the present into the future. The effect of that, if we experience, and it's typically the drawdown that really becomes the issue. We, in general, don't worry too much about the market crashing up, other than the fact that if you get a crash up, basically, where you have very high rates of return, that tends to reduce your expectation going forward. But it's really the downside risk that becomes quite problematic, because that creates an unfunded liability that then has to then be amortized through the policies of the actuaries. And that has then effects on the contribution levels to the employers and, raises up this whole issue of affordability. What you see in this is that if we were to replay with our current asset allocation, the events of the early 2000s, the tech crash, or the events of the financial crisis in the 08-09 type time period, that we would be seeing drawdowns in the portfolio of, $80 to $100 billion plus, given the current structure of the asset allocation. So this portfolio is still exposed to that kind of risk in it, and this extrapolates what would happen to the funded ratio should that happen in a one-year time period. So it could be fairly significant, to say the least, basically, if those kinds of events were to replay themselves. And this is not a forecast that they will replay themselves, but we need to be sensitive to that fact that this is still a portfolio that is exposed to that kind of possibility. Just a bit of context around equity drawdowns. The drawdowns are not isolated instances. even though the great financial crisis or the 08-09 experience represented the most severe drawdown actually since the Great Depression, the 1929 into early 30s time period. So that was the most severe equity drawdown that had happened. But if you go back through the 50s and 60s, you'll actually see protracted periods where you had quite a bit of volatility in the marketplace. So this all ultimately is, for us, from the perspective of managing the risk of this portfolio, in large measure, the management of the risk is to basically make sure we administer the fund in a way that allows us, since we have this growth-related risk bet in the portfolio, to try to maintain that bet through almost any environment. And that's one of the things that affected this fund in the 08-09 crisis, is we were not able to contain or continue exactly the same risk profile of the fund that we had had before. I think I'll stop with that, other than maybe just make a very brief comment that we are changing some of the structure of the performance reporting, not to reduce any of the information that's provided to you, but to try to increase the consistency of how the Public Employees Retirement Fund and the affiliate funds are presented. And consistent with the question that was coming up about the benchmarks, I think it was Ms. Brown's questions, you actually see the returns of the asset classes in the benchmarks. It's shown in some of the consent reporting under tab 5C, attachment 1, page 1, has both the asset class and benchmark performance set out side by side. So that information is available to you. And I think at that, I would just stop now and see if you have any questions before we go on to the consultants.
Yes, we, excuse me. Yes, we do. I had a question on the chart that you showed on attachment 2, page 13 of 24. iPad, page 156. Yes, and thank you for this scenario, what-if scenario, if you will, to see what the impact would have been. I know we had talked about presenting something like this for some time, so this is very instructive. But my question is, looking at the actual gain or loss, looking at the 07, 09, 119 billion, and just remembering when the financial crisis occurred, we lost $100 billion. So is it because the base is larger now that this is a larger number?
Well, that's a good question, Mr. Jones. I'm not sure. I
know it's not apples
the base
to
is
apples,
absolutely larger.
that.
So if you extrapolate that same degree of drawdown against a larger base, it'll absolutely add up to a larger number. Okay. There's lots of things that would go into exactly what's the experience that would happen, and we'll get into this during our program review, because we're basically also trying to identify ways to reduce these sort of eventualities. Right. How successful those efforts will be, have yet to be seen.
Right. Yeah, and the only reason I asked the question because I know our whole effort was to mitigate the risk if another crisis would occur in terms of our asset allocation and our public market assumptions. So that answers the question. Thank you. Ms. Hollinger?
Yeah, thank you. Really appreciate this. A couple of questions. So coming from insurance, I look at it's all about hedging our downside risk. So similar to what Mr. Jones said, as part of that, if we increase our allocation to private markets, would that be a buffer to hedging our downside?
I mean, certainly when we look at all the risk reporting that we have and the structure of reporting in the plan, we definitely see dampened volatility attached to the private asset exposures. There's absolutely a healthy debate that goes on, though, as to whether or not that truly represents economic reality,
right,
or is just an accounting phenomena. And honestly, it's difficult to sort those out. That's where I say, though, that basically for us, the risk management effort in this is to try to ensure that we would never have to force a transaction in any of those private assets, basically, if we were in a severe drawdown environment. So we'd like to not test the economic rationality of those things happening, but we definitely experience a benefit just from an accounting perspective of attached to the private assets.
Right. And my other question is this. This is also assuming that we're not in an inflationary period, because another concern I have is in a downside is with the COLA rider. And if all of a sudden we were to experience an inflationary period, that would make us spiral even further. So one of the things I look at is whether in going forward we need to have a policy that at least if we go below a certain funding level, that there is some kind of freeze so we don't spiral even further.
Yeah, you know, what you're bringing up is certainly beyond my pay grade, basically, for trying to, you know, hypothesize how you resolve that. But one of the topic areas that we'll be bringing back more information to you in the hopefully not too distant future is actually around the whole topic of inflation.
Right.
Currency is yet another topic that we owe you to return on. And the work that we've done, though, so far around inflation is that the picture on inflation is actually a little bit more mixed or a little bit more nuanced compared to how you just laid the context of it out. And the nuance is that because of the structure of how contributions are made to the fund as a percentage of payroll, if you have an inflationary bump, if you will, that has also tended to be correlated with bumps in compensation. So it typically has resulted in higher levels of contributions coming into the fund. So the timing of when those contributions versus when the COLAs take effect actually creates, it's quite a nuanced picture. And that'll be information that ultimately the actuaries can help bring back too. But it's not an automatically black and white thing that inflation, you know, immediately debilitates the fund or really makes it more stressful.
And I think just to add on that, if I may, as Eric said, we are going to come back with a sort of a real true inflation review on that. But what we're also working on a sort of parallel basis is be able to put all these numbers, which is the active risks, together with the funding ratio. And we hope to be able to come up with, I don't know if the policy is the right word, but to come up with a way to be able to kind of measure the level of active risks and how the funding ratio will kind of evolve over time, and be able to implement, if needed, in a very severe downturn, some measures that would, on the active risk side, that would protect the downside of the funding ratio.
Good. That's very good to hear. Thank you. I really appreciate all this.
Okay, that concludes the questions. So before I move forward, is that the end of this particular?
That's the end. We've completed our end. You know, you got it.
Okay, now we will move to the Trust Level Review Consultants Report. Wilshire, PCA, and Makita.
In the interest of time, so you'll have each of the consultants up here. We'll just move to the back row
Okay,
and we'll
fine.
allow
Thank
them
you.
to.
Okay.
Good morning. Andrew Junkin with Wilshire. I had to check my watch to make sure it was still morning. And I was fully prepared for 45 minutes of economic discussion that completely disagreed with Mr. Rothfield, but once I heard how much you liked his presentation, I decided not to do that. Actually, bold, thank you. We're really largely on the same page. I would say that we're constructive but concerned for a lot of the same reasons, and really it kind of comes down to the economy looks very strong right now. But we have some concerns about wages and employment that he touched on that I'm not really going to drag us all back through. Inflation, we do have some concerns about, coupled with tighter central banks. So those are kind of the high-level concerns. I'm in control of the clicker. Let's see if I can manage this. So starting on page 2, we like to update you on where our forecasted returns are. We run this exercise every quarter. There really are not significant changes quarter to quarter. These are 10-year forward-looking assumed returns. Haven't really been any significant changes from the beginning of the year, but that in itself is noteworthy. It means that things are pretty steady state right now. I'm going to jump ahead pretty far and hit a few things that sort of jumped out to us. This page happens to be related to the non-U.S. equity market, but I'm really going to be focused in the lower right corner on the really the notable spread in returns from different countries in the emerging markets. You can see Brazil down 26% during the second quarter. This chart is going to also be pretty interesting after the third quarter, particularly with the way things have started in Turkey just in the last week or so. So emerging markets, there's really been a lot of disparity there. I skipped over a few pages I was going to cover. I'll run back quickly just to sort of make the points I was going to make pretty quickly. So the economic review, again, I don't want to cover everything that Jonathan covered quite well, but 3 key points on this page for us. Consumer sentiment, well above the 10-year average. The 10-year average does include the global financial crisis, but we're back to pretty much the highs that we saw before the global financial crisis. Manufacturing, the survey there at 60, well above kind of the midpoint of 50, which is neither expansion nor contraction. So the economy looks good on both the consumer and the manufacturing side. And then the monthly job growth loss chart in the lower right needs to be renamed. We've gone 5+ years without a single month of job losses, which is pretty astonishing at this point. Employment conditions, as it was noted earlier, we've seen a huge increase in profits. What we have not seen is an increase really in wage growth. Those have been decoupled. That continues. There's been a little bit of upward pressure, but to the point that was made earlier, on a real basis, probably not so much. We actually, was interesting when I was going through his materials to see we both picked on sort of a time period within the labor force to pick on here. Labor force participation sort of broadly is held steady, but within the 25 to 54-year-old area, it's ticked back up. People are getting pulled back in. I can tell you anecdotally, Wilshire as a business, we're experiencing wage pressures. And I think I mentioned this at the performance and comp meeting a few months ago, we're seeing huge increases given as employees shift firms, sometimes on the order of 40%. So it's not to say financial services represents the broad economy, but as one part of it. Okay, back to where I was headed. Page 26. And I know that Makita will probably touch on this in the next slide that I hit. Buyout pricing multiples are still near the top end of the range at about 10 times. That 2018 number is kind of a first half number, so that could change pretty significantly depending on the deals that get done between now and the end of the year. I think more striking to me is the amount of dry powder. Now, this graph includes private equity, debt, real estate, infrastructure, and unlisted natural resources. But you can see $1.7 trillion of dry powder that's committed but not yet invested. You know, in addition to having a good economy, we do have very high asset prices pretty much across the board. It's hard to argue, and I think I've probably been making this point for 4 years, and the market's continued to go up during this time period, that there's a cheap spot in the market, right? Asset prices are high, are continuing to go up or have continued to go up. But things like this much dry powder probably will continue to provide some support in the private markets. Back to one of the other points that I referenced, central banks. You can see here, this is the graph of what the Fed balance sheet has looked like and the forecast for the runoff of the balance sheet. We've moved from an environment where the ECB was really kind of hitting the gas and Japan was kind of neutral to the ECB going to neutral and Japan starting to tighten a little bit. If we get to a place, and we probably will, where all of the large major central banks are sort of in a tightening posture, even if not radically tightening at the same time, that could have a pretty significant impact on I think somebody called it the animal spirits earlier. I think that was Richard. That's a radical change compared to what we've seen post 2008. We have not had that happen since then. Page 38, non-U.S. fixed income. Just pointing out here the bottom 3 rows, the dollar versus euro, the yen, the pound. If you compare the two emerging market lines there, one down 8.2, the other down 1.4 for the quarter, the difference is currency hedging. Currencies just got hammered during the quarter. That is continuing, certainly in the emerging markets so far this quarter. Just a few more pages here. Sorry, there we go. Real estate, vacancy rate is the red line here. You can see it's really been a strong market on the fundamental side. I think this speaks to the strong returns in the core property market that Elizabeth referenced. It's amazing. The apartment sector in particular, there was a comment about housing and renting versus owning. I travel a decent amount. It seems like every time I land in Denver, somebody started a new apartment complex and it gets filled about 3 months later. It's mind-boggling. And then last, I want to spend a moment on timber, which we don't normally do, but I think it probably is merited here. So timber prices are presented here on page 54, and you can see southeastern timber in the upper left, really pretty flat, in some cases down, depending on the type of timber, and this goes back 3 years. Compare that to the Pacific Northwest, just as an example, because it's got a clear pattern of increasing over time. The reason I bring up Southeast versus Pacific Northwest, obviously, is that Crown Pine, which has been an investment of yours that has struggled, has had significant exposure to Southeast. So the performance for the Forestland portfolio here is on page 56, but I just wanted to make a few comments about this. And as we've been discussing for some time, this portfolio struggled. We know that, largely due to that one asset with lots of concentration in the Southeast timber market. It was hit pretty hard. Timber prices in the Southeast were hit pretty hard in the global financial crisis because that tends to be the market that's used for home construction. You don't use Pacific Northwest hardwoods for home construction. But even as the housing markets recovered, those prices did not. So one of the reasons for the challenging performance, other than just sort of the poor timing on the purchase, which you can't know in advance that the market's going to collapse, other reasons included debt service and a challenging governance structure. So the performance that's reported here is before the sale actually is reflected in the performance. The next quarter, next 2 quarters will reflect the additional markdown that came, but really that markdown was coming regardless of the sale. There'd been a valuation. The valuation was going to push the market value down. The sale actually occurred at a price that was higher than that last valuation. So I think one of the questions I would want to know if I were in your seat, why now? Why sell it now? There was a very large principal payment coming up. Staff did a lot of very hard work that they shared with us. We worked our way through it as well, to really reflect on what's the future return of that large principal payment. And is Calpers better served by investing that other places like core real estate? And pretty much even under the optimistic scenario for timber, you were better off having core real estate. So I think that added some speed to the process, but in no way was this a panicked move. I think your staff spent a lot of time really thinking through the options and finding the best possible solution at this time. I do want to make one other point, and it's not timber specifically, but relates to another issue that the organization has right now, and that is changing leadership. So really, the timber portfolio was the beginning of the implementation of a vision that a CIO 3 CIOs ago had, and obviously, the market changed, and that vision wasn't fully implemented because subsequent CIOs had other issues to deal with, the global financial crisis being one of them. But as the strategic vision for Calpers changed, and as the focus in real assets changed from kind of a balanced approach between income and capital appreciation to more focused on high-quality assets in core real estate, focus on income, less focus on things like timber, this really, it did not become a fit, and then had to be managed kind of as part of the land of misfit toys. So as a result, I think, again, staff worked very hard to find the right outcome for Calpers. It's obviously challenging to lose money on a significant asset, but changes in leadership can have significant impacts on a portfolio. And when it's in illiquid parts of the portfolio, I think it's worth noting if there's a visionary or radical shift in how Calpers might approach something. Is this really going to be implementable over the long term? Because there are significant costs if it is not. And one of the issues was Calpers ultimately just couldn't buy enough timber to build a very large portfolio. So, hate to end on a bad note, but at the same time, I know other people up here would like to speak. Happy to take any questions.
Yeah, we have a couple. Andrew, what year did we acquire that asset?
I'm going to say 2007, and Paul's going to yell over my shoulder if that's wrong.
He's shaking. Yeah. Okay, so it's over 10 years.
Yeah.
Okay.
Yeah, and it's you've also had changes in the real assets team since then. Paul, I think, has been with you for 3 years now.
Yes.
So
Right. Okay. Ms. Taylor.
Yes, thank you, Mr. Duncan, for the. When I read your report initially, there was a lot of stuff in here. I wanted to ask you, because you mentioned it. So we have a government right now that's implementing tariffs most tariffs don't seem to be impacting the stock market, but you did mention Turkey. So I just read yesterday or the day before how much it is actually impacting the EU, which will impact us. How do you see that moving forward with our fund and sustainability of our fund?
I have to essentially take everything that I ever learned and throw it away when it comes to tariffs. I mean, I think that we've all... Now, there's two sides to this, right? Just if there is a bad actor in the global economy that is dumping product, and that has been the case with steel, for example, where China was producing massive amounts, wasn't the same quality. They'd agreed to sort of production limits. They far exceeded them and then sold it through other countries and then into the U.S., which really hurt U.S. producers. Those kind of actions, I think, if there are treaties and trade agreements in place, those should be adhered to. But just out and
Andrew,
out.
go towards the mic a little bit.
Sorry. Out and out tariffs, I think, we're into sort of a new realm that people haven't contemplated in probably 30 years.
And the Turkey one is being used as sanctions, basically, which are impacting, not necessarily tariffs. China's tariffs, I feel like the stock market, China, the European Union, we got rid of, we negotiated, but China's tariffs don't seem to be, we haven't really felt the long-term impact
Right.
for the businesses that it impacts, but the sanctions on Turkey, which end up kind of relating to this whole thing, and then impacting the EU indirectly or directly, and then us. So that's where I'm concerned.
Yeah, I think your original question was, how does this affect us? And at a micro level, it's hard for me to say, well, Turkey's going to be really horrible or a really great performer. We actually were joking about that on the drive over here, with the last time we saw sovereign bonds at 20%, it was Italy. And by the way, those bonds are now back below U.S. yields or pretty close to U.S. yields. So that one actually worked out all right. Turkey may be a very different example. I think what ultimately happens is consumers pay higher prices. And in a world where real wage growth is not fantastic or not present, that begins to cause some headaches. And one of the slides that Jonathan didn't touch on that I thought was really interesting was, and think, washing machine prices. And it only struck me because I just bought one like 3 months ago, and I thought, well, at least I got that done before the tariff caused the price to go up. I didn't even know I was saving money at the time. But there are some things that we've all come to incorporate into our daily lives, like washing machines, that you got to buy another one. You don't get to wait for the tariff to go away. Maybe you can wait until January for a sale or something, but ultimately tariffs are going to put stress on consumers, and consumers are 2/3 of the U.S. economy. So anything that creates a drag there, it's offset by the tax reduction. The math boggles the mind, certainly mine. But I think that's the biggest challenge for Calpers, is slowing consumer activity.
Slowing consumer activity. And then on that note, John had talked about the slow wage growth and then in particular sectors, et cetera. But I wondered what your thinking is in terms of a long-term impact of that in terms of a drawdown or whatever. How this really slow wage growth and almost wiping out any wage growth we had through inflation, how does that impact our long-term sustainability? Because it seems like, and I didn't add this, it does seem like the tax breaks that everybody got didn't really translate, and
Right.
and maybe we won't see that until after tax returns or.
Yeah, I think you're squarely back into the issue of income inequality, right? The richest 5%, they haven't had a problem with real wage growth.
Right.
The median down, that's been a challenge, and some of it has been general increases in productivity have kept wages down. They've kept costs down as well. I would argue, and it's impossible to make this point and be, reasonable, but, without the level of productivity gains that we've seen in the information revolution, as some people have called this age, inflation would have been higher, wage growth would have been higher. I don't know that we'd necessarily be better off, but I just bought my son a laptop for school, and it was like $400, right? And that wasn't the top of the line because he's 16 and he'll break it, but it was better than the one that I have at home that I bought 3 years ago that was $800.
Right.
So, those kind of things, I think they do affect the ability for wages to grow, but it's offset by productivity gains. Again, hard for me to reconcile those two.
All right. Thank you. Thank you.
Ms. Paquin?
Thank you, Mr. Chair. Thank you for the presentation. I think it was interesting hearing the staff presentation earlier this morning, too, and of course, during all the work we do with the ALM process about trying to de-risk the fund as much as possible. So I was curious, from your point of view, is there anything else that you think staff should be looking at that they're not currently working through and considering?
That is a much tougher question in this room than it is for almost any other client we deal with because of the size of the assets. Some of the things that other clients would have the ability to consider, quite frankly, are a challenge because of capacity. So I think certainly leading into the ALM process, we had a lot of these conversations with staff, and everything we think that could be implemented at size was either considered or is in process. So I think at this point, barring something like, a small allocation to 30-year strips in case there's a crisis, but I'm not sure that's the kind of strategy that you want to pursue.
Okay, all right, thank you.
Okay, no further questions. Next. PCA?
Thank you, Mr. Jones. David Glickman with Sarah Bernstein and Christy Fields from PCA. We are your board real estate consultant, and we're going to talk about the markets briefly. We're going to talk about your portfolio briefly, and Sarah is going to talk about ESG. There are 5 things I'd like to point out about markets currently. John, Elizabeth, Eric, Andrew have done a good job in setting the stage of what's going on in the global economies and the domestic economies. The real estate performance that you earned in the last year and over the last several years is an output. The inputs are capital markets and supply and demand of space for real estate. And as those change, those are the things that are going to determine, in fact, your real estate performance. A second part of performance to understand about real estate versus the publicly traded assets is a good portion of the reported performance is an opinion. Okay, they are based on appraisals. Part of it is based on the cash return, but a significant portion of the overall return, less than in the old days, but still notable, is based on a third-party outside evaluation. Those can be perfect or something less than perfect. Over time, it sorts out, but in any one shorter-term period, I think it's important to remember that those are appraisals and not realized sales. The second thing I want to reiterate and emphasize, as Andrew just did, is that nothing is cheap. And I've been a broken record about that for quite a few years, and it hasn't really changed much. There is still way more capital chasing high-quality, performing real estate assets than there are assets to be sold. And while we have seen, and this is the third point, somewhat of a moderation in prices as they increase, they continue to increase year over year. They are not increasing at as drastically improved amounts as they did in the third and fourth and fifth year of the recovery from the GFC. For example, the forecast for the next 10 years from industry pundits says that we should generate about 5% unlevered global high quality cash-on-cash returns. The look backwards for 6 years, that number has been closer to double that amount. So there's some narrowing, there's some slowing down of the appreciation. Unfortunately, for the kind of real estate that you seek to acquire and increase your position, that's the real estate that's still in the highest demand. And there are lots of different buyers, including retirement systems, but also including sovereign funds, also including high net worth individuals and partnerships who can buy those assets on different terms than you can afford to buy those assets. And so it makes prospecting difficult. Now you have available to you patience and you have scale, and from time to time you will find opportunities that are worth pursuing. But you have been disciplined over the last year, you've been disciplined over the last 3 and 5 years, and we think that's to your favor, even though you aren't quite at the level of investment as a percentage of your fund that you would have targeted. The fourth thing I want to point out is that the different property types have had different results over the last year and over the last 3 and 5 years. The industrial property sector overall has had very, very good returns in the last 12 months. The office sector has had the second best overall returns. Trailing those two have been apartments, for which there have been pockets of oversupply. And to Mrs. Yee's and Mr. Costigan's earlier comment about housing, the balance between rental and ownership is still moving back and forth. One of the reasons is home mortgages are easier to get last year than they were 3 years ago or 5 years ago. Deregulation and the change in underwriting standards have allowed households to qualify for mortgages that in 2015 and 16 they couldn't get. So in 17 and 18, more of them could, and that's tipped it a little bit more towards buying a house rather than renting. The last of the traditional real estate types in the markets that came in for performance was retail. And we have talked at other meetings, and we will talk in more depth in November about the changes and the disruption in retailing and how that affects the value of the retail assets that you hold. They did not perform as well during the last 12 months as they had in previous periods. So with that, I'll turn it to Christy, who will talk about the Calpers real estate portfolio.
Good afternoon. Just double checking. Christy Fields, PCA. Just a couple highlights from the letter that we submitted. The real estate portfolio now has a market value of $31.8 billion. That's an increase of approximately $1.3 billion, or 4.1% over the trailing year, which brings real estate to right about 9% of the total portfolio against a long-term target of 10%. The performance is highlighted in the table on the top of page 3. Although strong on an absolute basis, particularly if we look at kind of the 5-year number, which is appropriate to focus on for these private investments, the performance of the portfolio is trailing the benchmark over all periods, roughly 60 basis points trailing over the 5-year period. David's highlighted some of the market dynamics that are contributing to that, and we've seen moderating of returns across all portfolios, institutional investment portfolios. I would say that the deep diversification of your portfolio is serving its purpose. You've got certain sectors that are kind of starting to moderate more dramatically, like multifamily, while others like industrial and your data center portfolios are continuing to perform strongly. So that's working well. I think the other thing to note, and Elizabeth touched on it, was the importance of the core portfolio, and that's becoming an increasingly larger portion. It's now 78% of the portfolio as opposed to less than 50% several years ago. And that transition of the portfolio continues as a means of de-risking the portfolio and continuing to improve the durability of the income streams that you derive from that portfolio. Staff continues to deploy capital in a measured way, and with a not insignificant portion of the new dollars for the coming fiscal year tagged for investment and reinvestment in your existing portfolio. With such a large portfolio, you have, that is a little bit of a unique thing for you, that you've got a fairly rich opportunity set within the assets that you already own, to reinvest in those, to extend tenants, to attract new tenants, and to continue to improve the income streams there. I think I'll leave it at that and let Sarah comment on the ESG portion here.
Thank you, Christy. Two big overview points from an ESG point of view for your real estate portfolio. We've made a few notes here. First of all, looking across our client base, Calpers continues to be a leader in ESG. What I want to highlight here from your real estate point of view is that the actions you're taking, the programs you're putting in place are really seem to be accretive. In other words, they're not just looking ex post facto at which E, S, and or G factors are negative, but really seem to be able to help position your portfolio. And highlight two here, which is your energy optimization program and the responsible contractor policy and program, which have been in place for quite a while, is matured to the degree that it seems to be able to really help on critical issues in real estate, particularly at this time, which are human capital issues. The second point overall is the physical risks in the environmental area. They used to be seen as something that were not going to be important and really material to investment portfolios to the second half of this century. I think a lot of folks think that is been moved up, and your real assets portfolio is in an excellent position to start looking at those physical risks and material risks. I guess what I want to say here is it seems to be important, and your staff is moving to broaden that kind of look at physical risks of climate risk that are in the portfolio, not just energy transition, but climate physical risk throughout the rest of your portfolio. There's starting to be new databases out there that can, for example, look at the individual facilities of a global company, so not just where they're headquartered, but where their distribution, their manufacturing centers are, all of their facilities, and look at them in the context of different climate change. It's still modeling, but at least you're getting a sense of sea rise, extreme heat, flooding, et cetera, that hopefully can serve you well in the next few years. Thank you.
We'd be glad to take any questions, Mr. Jones.
Okay, thank you. Mrs. Martha.
Thank you. Are you aware of Prop 10, the rent control initiative that would repeal Costa-Hawkins in the state of California? The reason why I'm asking the question is I think it's, given that we do own apartments that, rental housing, I think it's worth us looking at what the implications of that might be and what the risk to the portfolio might be of that passing versus, or whether it would be accretive. I don't know, but I guess I'm just curious if you have any thoughts on that.
It's a little complicated.
Yeah.
It is dependent on the specific submarket in which your investments are located, what the rest of the housing stock is in that submarket, and alternatives for affordable housing. It's something that we would be glad to come back with a more detailed response. I don't have an answer for you as it relates to the apartment complexes that you own today.
Okay, thank you.
Ms. Taylor?
Yes, thank you, Mr. Chair. Thanks, you guys. This was a good report. David, I had a question for you on, I think you brought up that this last 2 years, I think you said, or last year, I'm sorry, has been, for purchasing homes, there's been some deregulation. Or purchasing properties, I should say. So my question that goes with that, and in our portfolio, is that impacting, are we able, you said we don't seem, everything's too high for us to continue to purchase right now. We're sort of sitting and being patient. So does opening those avenues and those regulations help us in any way?
I'm going to answer from a slightly different angle.
Okay.
But it speaks to deregulation and therefore the ability to borrow. The two things we keep an eye on really closely in trying to figure out when the party is going to stop and the music's going to be over
Right.
are oversupply of new product and increased amounts of leverage that are available. And to the extent, both for single-family homes and for multifamily apartments for rent and condos and townhouses for purchase, to the extent that the banks have an easier time making loans and the developers and the builders have an easier time borrowing larger and larger amounts on favorable terms, that's going to cause excess supply. And that's the point at which your apartment investments are going to be impacted, because the appraisers are going to say rents aren't going to go up very much until that oversupply of either new houses and or new apartments has been worked through the system. You have to remember in context that we've gone many years without there being much supply at all. And while Andrew's point about seeing a new subdivision or a new apartment complex being built every time he lands in Denver is probably factually correct, Denver went about 9 years without anybody putting a shovel in the ground. And so the 3,000 or 4,000 new apartments in Denver that should have been built on average every year, none of them got built. So if they dump 15,000, it looks terrible, but the market will absorb them over a period of time. So to try to directly answer your question about what happens to your portfolio is keep an eye on supply, keep an eye on the terms that borrowers can obtain in starting new spec deals, and to the extent that both of those rise, you're going to see the rate of increase in the value of your housing investments, apartment investments, begin to level off, and in some cases, for some short periods of time, may even decline in value.
Okay, and you kind of read my mind, because that's kind of where I was going with that question. And then in addition, we're seeing, and it was in the Sacramento Bee on Sunday, basically there is a decline in for, I think, this year, July of this year, of prices of homes in this region. Now, I know that's not in every region, but do we see that with so we have the weakening of regulations that can lead to and I don't want to say a 2008 issue, but you've got these deregulations, people are more easily able to get homes, yet at the same time you have interest going up. So I think that, to phrase that a little bit, but are we seeing a swing towards the prices starting to come down?
I don't think so.
Okay.
I think what you're seeing, and this is typical in a housing pricing cycle, is the duration is going out. The number of days on the market that a house is listed, the number of months it takes to refill a vacated apartment in an apartment community, that's lengthening out, but we don't see prices coming down. The new developments, the new apartment developments, are offering some free rent in those submarkets where they've had an excess of supply in a spurt. And the reason they can do that, Mrs. Taylor, is because they call that free rent an additional cost of construction. And they write that off as part of their capital base, as opposed to changing the rent on the sticker, which is how the appraisers look at what the ultimate value of the property turns out to be. So we're not there yet, but as trying to help you with our best guesses to look around corners, we would say keep an eye on the supply of new construction and keep an eye on the levels of leverage that are allowed, because that's not like 2008, not 2009, but those are where the cracks begin to show up.
Okay, great. Thank you.
Mr. Miller?
Hi, and this may be a little further afield, but I'm curious, just how specific is the segmentation when you can look at areas of, say, new construction or opportunities? And the example that I really want to kind of bring to mind is, in California at least, when it comes to like assisted living or board and care, it seems like about 60 to 80% of the existing capacity, which is nowhere near what the market wants or needs, is single-family dwellings that weren't built for the purpose, that have been kind of modified or converted, and that almost every jurisdiction seems to be doing whatever they can to encourage, make it easier to put in these kind of facilities and operations. Is there any kind of good information about opportunities for kind of new construction or building to spec for those kinds of investments, for assisted living, board and care, versus just a regular standard residential dwelling, whether it be a single unit or multi, quads, fourplex, up to small apartment-sized buildings? Because there seems to be a tremendous demand, and certainly our membership with the demographics, there's a need out there, without even getting into the kind of long-term care style facilities, but just smaller, typically 4 to 12 or 14 unit kind of operations.
So senior care sort of divides broadly into government assisted and private pay. And the economics of building senior housing for government pay rates are terrible. That's a big drag on the creation of new ones. And that's why existing stock, as you described, like a single-family home, is being converted for that purpose, because it doesn't make sense to do new construction. You'll never get the costs properly returned. For private pay, there has been a reasonable increase in the number of new developments, and so some of the large healthcare REITs that specialize in this business have had earnings that have not grown as fast because there's been some absorption that's necessary. But in those cases, you have the ability to charge the market what would be necessary to justify the cost of construction. It's a lot harder to do in California, where the cost of land and the entitlement process and notwithstanding the public will to try to create more of these facilities, the different jurisdictions have different requirements that have to be met before you can begin construction, and the combination of those high hurdles and the cost of land and the cost per square foot of construction and the availability of labor all combine to make it a very, very uphill effort, especially looking at it from the point of view of, am I going to get a decent return on my investment?
Yeah. Thank you.
Mr. Slayton?
Thank you, Mr. Chair. David, I want you to expand on the energy optimization program, because there's information here, but I don't understand quite what this, well, or one of you can, on the scale. So 17 projects, $6.2 million, with a present value of $19 million. So what's the potential? What's the market? Who makes these decisions? What's the decision process that's used to decide to do a project or not do a project?
I'll start, and then I'll ask Sarah to please join in. And I see Mr. Muchaka is here, who actually knows the answer to your question. Every year, as part of the annual investment process for each one of your separate account managers, one of the charges they are tasked with is coming up in their annual plan with a request for capital, and in part to do tenant improvements and to pay leasing commissions, but also specifically, how can we make this a better return on investment? And when Christy described one of the areas of your portfolio where you're going to make a good incremental return on investment as being investing in your own properties, energy is one of those places. So the managers who actually operate the properties on site will come back and say, here's what we think we can do, here's what it costs in our community to add solar, here's what it costs in our community to recycle water, and so on and so on. And then as part of the capital budget to be approved prospectively in each fiscal year, the real estate staff will consider each of these investments as, does that make sense? Is that a good risk-adjusted return? And then they are given, the managers are given the green light and the capital to implement those programs.
This is Sarah. Yeah, and Paul's going to have to fill you in on the details of where you're at with making proposals into systematic application across your portfolio and the potential for that. So these are all estimates, but Paul, if you want to go ahead.
Thank you, Sarah. Paul Muchaka, investment staff. I think David summed it up perfectly. The only thing I would add is we tried it last year in the 17-18 fiscal year as a pilot project, and now we're rolling it out over a broader part of our portfolio. And really it is that balancing act of trying to reinvest in our portfolio in an accretive way and make a difference. One of the big things that came out in the research was when you're in the process of improving one of your existing assets, that is the opportunity to attack this potential opportunity to improve the value and the operations of the property.
So, but the scale of them, so you have 17 projects out of a universe of potential. Are there a whole long list that get rejected? What's the return portfolio? What does it have to reach? What's the threshold?
So we've engaged a consulting firm to help us first sort of create an inventory, or a library is probably a better word, of all the different types of projects that we can undertake in a portfolio as large and diversified as ours. We really just started that, I want to say, about 8 or 10 months ago, and we're in the throes of going through all the library that we're soon to be provided and try to roll that out. We're working really side by side with our partners too, in addition to the consultant, to try and see how big this can get. So the real short answer to your question is we don't know at this point in time, but we're trying to set it up in a way that it can either go in the side of more of a project orientation like we have today, where it's one discrete project after another, or it could be a policy that sort of governs one of the components of managing this real estate portfolio.
So it just seems to me that given where the technology is, the ability, this is a fairly low risk area to work in to get additional returns. So to me, it's kind of a no-brainer. We've been talking about risk-adjusted returns. This is one that's far toward the end of fairly low risk because these are fairly predictable projects, or at least many of them can be very predictable in terms of what the return is. So I think it's great, encourage it. 17 projects sounds like a small amount, but we're in the second year. So hopefully we can see a much higher number of projects and investment going forward.
Thank you.
Thank you.
Ms. Packgren?
Thank you, Mr. Chair. Thanks for the report. I really appreciate it. I was interested in what you were talking about with regards to the climate change impacts on the real estate portfolio and the fact that there's now more tools that are out there to help evaluate and monitor those risks. So I was hoping that we could hear a little bit more about that when staff is ready, hopefully sometime in the fall in the annual review. Thank you.
Okay. Yeah, David, you made reference to investments by high wealth individuals and various other funds in the real estate area that Calpers cannot do because of who we are. Could you expand on that and describe some of those terms that you were?
Yeah, in brief, when you look at high net worth investors, sometimes that's flight capital. So an investor who wanted to move money out of a politically unstable place and buy a trophy building in the United States isn't really worried about getting a market rate of return on that investment the first year or two or three. They're more worried about moving the capital and having it not be subject to forfeiture in their home country. So if they want to buy an office building in Hong Kong, because they're a Chinese national, but they want it out of China, and they get a 1% return on investment for the first few years, they can pay a much higher price than you who needs somewhere in the 4 to 5% first year current return. So that would be one example. Another example would be a sovereign wealth fund that didn't have a liability side to their balance sheet the same way that a retirement system has. So whereas you have fixed obligations over time that need to be serviced by the income from the real estate and the other assets, a sovereign wealth fund might not ever have that obligation to pay, and therefore their idea of pricing for the long term is going to be different than yours.
Thank you very much. Okay, Makita?
Yes, good afternoon. Steve Hart from Makita Investment Group, or a private equity board consultant. I'm joined by Hannah Schreiner, also in our San Diego office. And we plan to go through our report today. We'll make it quick. We just, the sections, just a quick introduction, talking about the private equity industry, review of the portfolio, some performance, and the activity in the portfolio. So in terms of an overview, currently have about just over $27 billion of exposure, NAV, in the portfolio. Total exposure of just over $41 billion. That includes the unfunded capital commitments, and is about 7.7%, just below the target allocation of 8%. The portfolio itself diversified by strategy, with the buyouts being the largest segment. As you may have noted in the policy review discussed earlier, there was an uptick in the range for buyouts to be from 60 to 65% is the target there. So where the program is now is in line with that. Exposure by strategy, funds continues to be an increasing share of the overall exposure. Now it's 72%. Customized investment account fund to funds, co-investments are shrinking somewhat. In terms of performance, the value of the portfolio overall, including a net return of capital, increased by $1.6 billion in the 6 months from January 1st to June 30th. And while the program has underperformed its policy benchmark, as was discussed earlier, it's been a very strong return, 6.1% for the year, but over longer terms, it's been quite strong as well. And we do note that the program, when you look at it against a pro forma of the new benchmark, which is the FTSE All World, it is meeting or exceeding those benchmarks on the 3, 5, and 10-year basis. Just as a note, the program had a net positive cash flow, meaning there was more distributions than contributions over the 6 months of just over $1 billion. And we would note that since 2011, over just about 6 years, Calpers has received over $31 billion, of nearly $31 billion of net cash from the portfolio. So Hannah's going to pick up on the industry.
Okay, thank you, Steve. Hannah Schreiner with Makita Investment Group. This first slide here, I'm only going to go through a few of the market slides that we've included in this deck. And this first one goes over the U.S. buyout activity through the first quarter. And what you can really see on this page, if you focus on the right-hand side of that chart, is in 2017, the deal value in terms of dollars has remained relatively stable throughout the year compared to 2016 and 2015 as well. And the blue line that you see above that with the number of deals closed also continues to remain stable throughout the past year. And if we look at 2018, this just represents the first quarter, remember, there was a decrease. And we don't think that that's telling of the rest of the year activity. We just think that it's an output of the first quarter lumpiness of the market activity. If we turn to the next page, something that we wanted to kind of point out is that costs do remain high. As you see on the far right-hand side, multiples remained at 10.5x for the year of 2017. And so while this remains at peak levels, leverage also continues to be high. And one thing to consider here is that a lot of this leverage includes that floating rate debt. And as interest rates rise, one thing that we're going to see is that the leverage is going to get more expensive, and so that could have an impact on the leverage within these funds. If we look to the next page, looking at the exit activity within the U.S. buyouts, what you'll see here again, continuing the same trend of the investment activity that we pointed out on the first slide, is that in 2017, relatively stable at $213 billion versus 2016 was at $215, and the number of exits again stable at about 1,179 versus the 1,249 for 2016. Again, exit activity did slow in first quarter, but again, it's just one quarter for the year, and we don't think that's telling of the rest of the year. And we can flip over to page 12, yes. So just touching on the venture capital, market, we think this slide is very important because you see that each of these lines, which represents a different round size within venture capital through the end of the second quarter, and you see that each of these lines are trending up. Starting, the purple line represents the angel seed, the middle blue line represents early venture, and then the top line represents the later venture. And you see over the past 5 years, each of these have more than doubled. One thing to note, though, is that these funds that are staying in market they're staying. Their age is increasing. So relative to exiting earlier with the smaller levels. So that is one thing to consider. If we turn to the next, take a look at fundraising. One thing to point out here is you see 2017, the purple bars represent the capital raised by dollar value, and then the blue line, again, number of funds closed through the first quarter. And what you'll see is the purple bars are trending up, where the blue line is trending down. And so what we're seeing in the market is a trend that has continued, is that GPs are increasing their fund sizes, while the LPs are increasing their allocations, but to fewer funds. So it is a trend that we do, see continuing. And, when we look at, first-time managers in the market, they do account for 10% of the vehicles in 2017. So we are seeing an uptick of those managers coming to market. In 16, the final slide that I'll go over for the market update. These lines, the top line represents the average fund size for the U.S. buyout market, and the bottom line represents the median fund size. And what's really notable to focus on here is the 2017. The average fund size was over $1 billion, which it hasn't been since 2007. And, for the first quarter, there was a decrease in the average fund size. However, 59% of the capital that was raised during the first quarter went to the 10 largest funds, which again, goes back to the previous trend with GPs raising their fund sizes, but then also LPs increasing their allocations. And with that, I'll turn it over to Steve to go over the portfolio.
Okay, so just quickly on the portfolio here, as I mentioned, the buyouts remains the strongest, the largest portion of the portfolio, and is within the ranges noted, as we discussed before, that the target range for the target for buyouts has been increased to 65, and for credit's been decreased to 10. So the portfolio is essentially in line with expected allocations. The slide here showing that the net asset value by region, the United States remains a dominant portion of the exposure at the fund level, but also a note on the next page here that at an asset level, looking through the portfolio, it's a little less on the U.S., a little more in Europe, and that comes from the fact that there are some U.S. funds that make investments in companies that are located in Europe and other regions. I think we had shown here that the vintage years, the commitments that had been made in the 2006 to 2008 timeframe sort of outweigh what we see in the following years. But in terms of the amount of uncalled capital, those years, 2006, 2008, are a much smaller proportion. We look at the what's unfunded in the more recent years as where the balance of the capital is going to be coming from, not the older funds anymore. So I had mentioned that net asset value by the structure, that funds remains the strongest and the largest part of the portfolio, and that the customized investment account is a smaller portion of that and has shrunk somewhat over time. The largest manager relationships, this table doesn't change very much, especially the top three there. There can be an occasional change in the fourth or fifth, but it doesn't change very often. And we do know that staff did make commitments to Blackstone Tactical Opportunities and the Carlyle Fund during the last 6 months. Wanted to highlight, this is a page that I commented on earlier, showing the distributions and contributions that were made on an annual basis, and you can see beginning in 2011 that has remained quite strong, that the amount of cash coming back to the plan has far exceeded the amount that has been drawn by the underlying funds. But you can see that beginning in 2013 that trend has begun to change. And in 2018, it's almost back to a flat, and that's basically showing the impact of the new commitments that have been made over the last couple of years.
So this slide here decomposes the change in the program value from January 1 through June 30, 2018. And the far left, you see the beginning net asset value of $26.7 billion. And as Steve had already mentioned, contributions and then distributions are outpacing those contributions. However, there was that strong positive change in value, which did attribute to a total value increase of $400 million for the first half of 2018. Next, just looking at program performance, a few of these data points were already covered, but if you look at the top line, you see that the Calpers PE program over the 1, 3, 5, and 10-year periods has produced strong, absolute performance. Versus the policy benchmark, it is lagging, and versus the Cambridge Associates, which is the industry standard benchmark up here, is also trailing behind that as well. The third line here shows that the FTSE All World Index plus 150, which is that global public market index, plus a premium. And you will see over the 1-year period it is slightly trailing, but over the 3, 5, and 10-year period it is outperforming. And one thing to note, too, is that over all periods measured on this page, the program is exceeding the projected return of 8.3%. So that is something very positive for the program. On the next page, breaking down kind of what's been contributing to the overall performance for the program, looking at a strategy level, buyouts, Steve had mentioned, they are about 64% of the total program. So really driving that overall performance. Had a very strong performance over all periods at the 1 year at 19.8%. Growth and expansion, 2 rows down, is also very strong performance for the 1 year at 16.9%. While as venture is posing a small drag. The next page, breaking it out by different structure, you see funds, 4 lines down, does contribute the most to overall performance. The 1, 3, 5, and 10-year very much in line with the overall program value. And then lastly, looking at the performance by geography, the top line there, the U.S., which represents about 70% of the total program, again, driving much of the performance. The 1 year, slightly behind the program, 3, 5, the 3 year as well, but over 5 and 10 years, just slightly either in line or outperforming. And then I'll turn it over to Steve to just talk briefly about the program activity.
So just quickly here that this is a look at the investments that were made by the staff over the last 6 months. 8 managers were selected, 10 overall commitments, and essentially on pace with the plan that was expected for the whole year of about $6 billion is what's expected for the full fiscal year, and at 2.7, just showing that it's about on track. Happy to take any questions.
Okay, thank you for the presentation. Ms. Mather.
Thank you. My first question is on page 30. Excuse me. I'm sorry, I'm just going to that page, which is page 398 of the iPad. I just wanted to note that while you have distributions in red, which makes it look like a negative thing, it's actually a very positive thing. This is cash being returned to us as the investor. So obviously, to get to the end NAV, you have to net it out, but I think it makes it look like we lost $3.2 billion, and that's not what happened. It got returned to us, and we're reinvesting that in other things, either correct. In private equity or somewhere else in the portfolio. So I just wanted to make that note. On page 9, you talk about and 10, you talk about private equity exit activity, and I'd note that 26% of private equity exits are going to another buyout fund, basically. That's what the secondary buyouts
That's correct,
means. Yeah. Do we have a way, I know this is market-wide that you're showing here, but do we have a way of looking at our own portfolio and seeing how much are we selling to ourselves through, I mean, I imagine we know the answer to this question, but how much are we actually selling from one fund that we might be into another fund that we're also in?
Yeah. So I don't have that data in front of me here, but I would just note that on this particular page here, on page 10, that 26% is represents just the first quarter of 2018. And you may recall in other reports we've given that this share of secondary buyouts has been increasing, and is nearly up to 50%. Was at 40 and has been creeping up to nearly 50%. So it's becoming a larger part of the overall portfolio, the market activity. Would say that a reason that it appears in the first quarter why the market has shrunk is I think there's been less secondary buyouts. Just bid-ask spread between different managers has not been able to be met, so they haven't done deals. I would think that the pair system possibly has some information points to be able to see what would be the data on, manager to manager transfers among the portfolio. That being said, my guess is that it would be, if I had to make an assumption, my guess is it's going to be less than market, because a lot of these secondary buyouts are from small managers to medium and medium to mega, and the strong share of the portfolio is in the large and mega, so there's less trading of those investments. Those tend to go strategic as opposed to another buyout manager, but we can see if we can have some more data on that.
Okay, I mean, I think the important point to me to make as we're considering this direct model that we have shared publicly, we're considering, is that is one driver of interest, of my interest in the direct model, is to avoid this sort of periodic requirement to exit. We might want to own a company for a long time, but we also want to avoid sort of the leakage that happens when you sell from one fund to another within your own internal portfolio. So I just wanted to make that point. Thank you.
Great.
Mr. Juarez?
Yes, thank you. Just quickly, the question as it related to, or two of your charts, and you don't have to go back to them, but maybe if you know, just generally off the top of your head, how we compare relative to other major institutional investors on two fronts. One is the distribution amongst the various strategies. We seem to be heavily laden in buyout, and maybe that's a good thing, but that's what I would hope you would be able to tell me. And then our concentration in the U.S. versus being more spread globally.
So I'll take the question from the perspective of other large U.S. public plans. And I would say that, just as a blanket statement, that the Calpers portfolio is pretty close to what other U.S. public plans are. They're going to be relatively more concentrated in buyouts, especially in larger buyouts, and they're going to be more concentrated on the U.S., with Europe being second. So I don't, without comparing statistics, my sense is that the Calpers portfolio is generally in line with a number of the other large plans.
Okay. All right. Thank you.
This is Steve McCord at Makita. Just to add to that as well, it's also, all these funds are roughly in line with the universe of private equity opportunities, which is largely U.S. dominated and largely buyout dominated as well.
If I might, just it would be interesting to see if we in fact move to the more direct investing model, whether or not we hold to those same distributions going forward as a direct investor, and whether or not, in fact, we don't get. And again, it may be, as Steve said, it may be just where the opportunities are.
Right.
But
so I would say there's two parts of that. As you know, there are two of the pillars that are being discussed. One is the longer term strategies, which is going to tend more towards the buyout side of things, right, and the technology or innovation, which would be more towards newer growth. So that, to the extent that kind of develops, that's going to have some roll-on impact in the portfolio. The second, I would say, in terms of geography, with private equity now being sort of pulled together with the global equity, one of the ideas of that move is to free up the private equity staff to just choose the best managers they can find, without having to think about overlays of either geography or industry. And that the global equity portfolio can make some adjustments in the overall equity exposure to compensate for that, to make any tactical bets, things like that. So it's in early days for that. So I would think on the geography exposure question that a more complete answer is going to be looking at the overall equity portfolio.
Thank you.
Ms. Taylor?
Yes, thank you, Mr. Chair. I just had a quick question on pricing. So you talked about, we have a lot of dry powder. We talked about a little bit about the cost of private equity right now. So Tesla, and it just came up in a flash on my screen, and I lost it, and I can't find the story right now, but Tesla is looking at getting out of the stock market and going private. So
at least Elon is talking about it.
Well, Elon's talking about it. I don't know. It looked The little headline I saw looked more definitive, like there was some decision-making going on, but again, I can't find the story now, so. So I wondered what role does PE have in the number of public companies that are going private, and does that impact that cost in dry powder that we're talking about here?
So I think the dry powder question, a couple of quick comments on that. One is it's very large. I would also, and I don't have the statistic in front of me, but a way to look at it is how many years of deployment is that dry powder? Because the market's gotten larger, so comparing necessarily dry powder to what it was 10 years ago or 20 years ago is not as valid a way to look at it as maybe some other measures to think about it. So that's one. The other is that it vastly underestimates the amount of money available to invest in private equity, because all the programs that have co-investments or other ones that, CPPIB that does direct investments, those are not included in that dry powder calculation. So the amount that you see is actually understated. What's reported is understated of what's really available.
Oh, wow.
So that is a consideration. So in terms of the how private equity would be involved in taking private, so that's been an activity that's taken place with private equity for a long time. That being said, at stock market valuations where they are today, it's not a strong feature that takes place. There is not a lot of take privates. I'd have to look at some statistics, but it may be relatively balanced right now. The IPO market has been pretty strong, and there have been quite a few private equity-backed companies, both in venture and in buyouts, that have gone public in the last couple of years. So I don't know if it's a straight kind of wash, but I think from a valuation perspective, kind of a bootstrap, how you can think about taking a company private and then build it up in private equity. It's not a super attractive time right now. What has been happening more is as companies are more focused on the particular businesses that they want to be focused on, there have been what are called carve-out deals, where private equity would come and purchase a portion of a public company, let's say, and work with that. So I can see if I can get some statistics to more.
Yeah, because I'm just wondering if we're going to get involved ourselves in this space. I want to know if we're looking at good prices, or is this driving the prices up, or
right.
So yeah, that would be good.
Okay.
Thanks.
Okay, let me see. I think we have one more report, but I think I'm going to pause for a lunch break and then return to Makita's on infrastructure, right? And okay, so why don't we do that? We'll return at 1:45.
That's good. Because then we got